Welcome and good evening everybody, and a very, very warm welcome, if a slightly soggy one, to you all. My name is Professor Frances Bowen and I'm Pro-Vice Chancellor for Social Sciences here at UEA. I'm also a faculty member at MBS with interests in non-financial disclosure, so I'm very excited about this evening's talk. And it's my great pleasure to be introducing Professor Ana Marques tonight to you. Ana began her academic career in Lisbon, in Portugal, at the Instituto Superior de Gestão, where she gained her first and second degrees in management in 1998. In the years that followed, Ana gained her PhD at the University of Texas in Austin. She returned to Lisbon in 2006 to join the faculty of the Norwich School of Business and Economics as first assistant and then associate professor. While tenured at Nova, Ana spent 3 years visiting the Indian Institute of Management in Bangalore, in India, where she contributed to its MBA program. Ana joined us here at the UEA, Norwich Business School, as Professor of Accounting in 2018. Very warm welcome to you. It's quite swift to actually have an inaugural just 1 year after you arrived, so I'm very glad we were able to make that work. Over the past decade, though, Ana has served on numerous international committees. She's currently the country liaison for the UK of the international section of the American Accounting Association, and Ana's also a member of the Financial Reporting Standards Committee of the European Accounting Association, the EAA, and of the Scientific Committee of the Annual Congress of the EAA. Until August of this year, Ana served on the Council of the American Accounting Association, AAA, or AAA, and on the AAA's Global Engagement Committee. I should have checked with you how to pronounce the acronym. But Ana's work has been published in many highly regarded publications in her field, including the Review of Accounting Studies, the European Accounting Review, the Journal of Business, Finance and Accounting, and the British Accounting Review. Ana's research interests include the disclosure of non-GAAP earnings, or alternative earnings measures, which she's going to talk about primarily this evening, I think, corporate social responsibility, corporate governance, and international accounting. And personally, it's in the work in the corporate social responsibility area that I'm familiar with Ana's work before I came and joined UEA, actually at the same time as Ana. Her research has been funded by a Marie Curie grant, with projects approved by the Foundation for Science and Technology and other sources. So please join me now in giving a very warm welcome to Professor Ana Marques to give her inaugural lecture to us this evening. Welcome.
Okay, thank you all for coming. Thank you, Frances, for the kind introduction. And as Frances mentioned, today's talk is going to be about alternative performance measures, okay? And at first they asked me, okay, what exactly are you going to talk about these measures? And I said, well, the big contention here is, do the managers really disclose these measures to inform us, or are they just trying to mislead us? And I can tell you right now that the answer is, it depends, okay? My students don't like these kind of answers, but I'm going to discuss with you what it depends on, okay? So that the next time you see one of these measures, you can make your own criticism of how it's disclosed, how it was calculated, and make your own mind whether or not you believe it, okay? So here's my outline for the presentation. First, what are these measures, right? So if you don't know what they are, in 5 minutes, you'll be set to go. And then, how can the good practices, so how can we motivate the good disclosures? I will finish off with what's being decided for the future in terms of regulators and accounting standards, and then a brief conclusion, and I'll take questions at the end, okay? So what are these measures, right? So imagine that the firm has just finished its quarter, the analysts are waiting to hear what their earnings were, and they come out and they say, adjusted earnings were 50 cents, okay? And the analysts were expecting 45 cents, and all of a sudden, if you track the map on Bloomberg, the price of that stock is going up, right? It's automatic, right? If you announce an earnings measure higher than the measure that the analysts were expecting, your price is going up. The question is, what are those adjusted earnings, right? Because in reality, we, the accountants, would expect this earnings number calculated according to the standards, right? And most probably somewhere in that press release, there is also the accounting number. But this number, this adjusted earnings number, let me see what is going on at the top. Something weird. Okay, it's gone. So this adjusted earnings number is not something that is calculated according to the standards, right? So at some point, the managers looked at the accounting number and figured, I don't like this number. Okay? I'm going to change this number. Okay? There's a million different reasons why they may decide they don't like that number, but the fact is that in the same press release, you can have 20 different measures of earnings. Okay? And some of them are according to the standards, and some of them are not. Right? So these are the measures I'm talking about. The first definition, official definition, we're not going to go through that, of course, of what are these measures was put out by the SEC in the US. Okay? So in 2003, Regulation G came out and said, look, there's a bunch of these measures going around that do not follow any accounting standards. We need to put some order into this. We need to come up with a rule. Okay? And they put the rule out and they said everything that describes financial performance, financial position, cash flows, and does not follow regulations or standards or generally accepted accounting principles, that's why we talk about GAAP, then we consider that it has to have some structure. The manager has to justify why they are disclosing these measures, and they have to let us know how they calculated it. Okay? Of course, that was only applicable in the US, right? So that's our initial definition, right? If it does not follow standards and it describes performance, financial position, or cash flows, then by all accounts, it's a non-GAAP measure. Okay? Now, here's an example of CVLs. Okay? I went to check their latest press release, and this is what they had in the top of the press release. So the first thing that they said, people out, are these bullet points. Okay? And you see, revenues increased 35.2%, so good to know. And then they say GAAP operating income increased to 3.3 billion, no longer an information on percentage, please note that. And then they say adjusted operating income increased 55.1%. Notice the percentage is now back, okay? But this is not the regular operating income, this is adjusted operating income. Notice the one, okay? Then you go on and they tell you GAAP diluted earnings per share from continuing operations 1.49, again no percentage, but then you have the adjusted earnings per share of 1.89. So what comes to mind right away, if you look at this carefully, is that a non-GAAP measure, for some wondrous reason, is always higher than the GAAP measure, okay? And to be completely honest, it's not always, but it's around 90% of the time, okay? So statistically speaking, there are cases where the firm comes out and says, no, we believe that the number according to the standards is too high, and if you want to focus on our performance, here's a lower number, okay? But those are not the most frequent cases, okay? So given that CVS is in the US, it's under Reg G, and Reg G says you have to explain to us what these numbers are. And sure enough, they do, okay? They provide us with this nice table. You can see it has here the information about how they calculated those numbers, right? So what did they take out? What did they think they didn't like, let's say, from their GAAP calculation? So they took out amortization of intangible assets, acquisition-related costs, goodwill impairments, interests, tax benefits, and then some income allocated to participating securities, right? And as you can see, both this year and last year, the non-GAAP number is higher than the GAAP number, because what these firms mostly take out are expenses. So mechanically, of course, you're going to get a higher number. And there is another impact that is very common, which is, notice what happened in 2018. If they were to just disclose the GAAP number, they would have to come out to the public and say, we had a loss, okay? And everyone knows capital markets do not enjoy losses, okay? But if they come out and they disclose the non-GAAP number, now they have a profit. It's 1.69, okay? So this is, again, a very frequent scenario, right? The firm has a loss, some adjustments are made, and out comes a profit number that they can announce in the earnings announcement, okay? So, if you're reading a press release or a news article, what should you look for? If it's adjusted EPS, for sure, it's not GAAP. What about if it's an EBIT measure? Okay, so most people think EBIT is fine. Everyone knows what EBIT is. It's earning before interest and taxes. It's as clear as you can imagine it, okay? And then I do an exercise with the students, which is, okay, go to the financial statements, get earnings, and just deduct interest and taxes. Let me know how much you come up with. Then I have them compare that with the number that the firm disclosed and called EBIT, and it never matches. It's a miracle. What happened? The firm did not take away all the interest and taxes. They picked some part that they thought or that they claim are non-recurrent, and they said, we have this adjusted EBIT measure, okay? So EBIT is non-GAAP, operating profit also, EBITDA, of course, like the EBIT, it's exactly the same scenario. Free cash flow, if you go to the CFA analyst's book, there's a definition. You go to these firms and you can find 20 different definitions, no problem, okay? Core earnings, adjusted net income, highlight earnings, and many, many other names, okay? Now, what is the big discussion, right? Here's what some people say about it. These are earnings before the bad stuff, okay? These are the critics, needless to say. Or how corporate executives fudge the numbers to inflate profits, okay? Another reason that people complain is once a firm adjusts for 2 or 3 things, and the next firm comes and adjusts for 2 or 3 things that are different, how can we now compare these figures? Okay? Even if the firm is the same size, operating in the same industry, whatever, we have lost comparison, okay? And this really upsets analysts, okay? They go crazy. They don't like it at all because this, of course, messes up with their models. Another thing is that it has been proven that in some scenarios, these numbers lead investors to value stock higher than if they knew exactly what the GAAP number was and if it was explained to them how those numbers were calculated. So there are scenarios where investors are clearly misled. Okay? What do the, let's say, defendants of this measure say? Well, it provides the manager's point of view, right? They're the insiders, they have all this inside valuable information. If they're telling us this is the real number, we should believe it, okay? Another thing that it's claimed is that whatever is taken out are non-recurrent items, right? And as we all know, for valuation, we need to have a long-term perspective of the value of the firm, so we want to know what is recurrent. And finally, most of the studies show that, in fact, these numbers are more informative than the GAAP numbers for capital markets, right? So, yes, there are some scenarios where this is, let's say, worrisome, but there are also some cases where we see that, on average, these things do contain information. So people do use this to make capital market decisions, and good ones in some cases, okay? So where can we find these numbers? Like I mentioned in press releases, it's extremely common. News articles, annual reports. And lately, there's a new trend, okay? Social media. So this picture here is from Twitter. It's on a paper that is looking at Twitter non-GAAP disclosures in the US. Why? Because Regulation G applies to everything that is filed or furnished to the SEC. Or a Twitter does not have to be furnished to the SEC, and therefore they can do whatever they want, okay? So notice the very big numbers, plus 4% full year organic revenue, and then notice the very tiny 1 that leads you to read underneath full year reported revenue decline 4%, okay? Now you have the next number, plus 6% comparable currency neutral income before taxes. God knows exactly what that is. And the small 2 leads you to something underneath that says structurally adjusted full year reported income before taxes grew 3%. Okay? So yes, you can say whatever you want on Twitter, and the SEC is not coming after you because you didn't furnish it to the SEC. Okay? You just post it on Twitter. Now, when did my interest start with all of this? Okay? So, of course, I was there when the SEC put out Regulation G, so I was doing my PhD in 2003, so I heard all about this. And then my advisor, the person in the middle, Ross Jennings, said, oh, you can pick whatever topic you want. Just go ahead, do whatever you want. And I came up with this topic, and I said, but there are 2 papers published on this, just 2. So I really do not have a reference list to give you. And he said, oh, it's fine, you can do it. And that's it. I literally jumped without any net because there was nothing out there, so I had to kind of make up my things. And in the end, he was kind enough when he wrote all those reference letters when I was job hunting to say, well, she was here for 6 years, it's true, but she had 2 kids during her PhD program. So that's the last picture you see there. So out of Texas, I did get a lot of stuff, right? I got a nice friend, he was my co-author on a couple of papers, and that's when my interest in these measures started. Now, the question we want to focus now is, if these numbers are around, so what can we do to have them be good numbers, informative numbers, numbers that we can rely on and that we can use? So there's a bunch of stuff that you could think of, right? The easiest one, and the one I just mentioned, is, well, someone comes up with a regulation and that's it, and then they have to let us know how that number was calculated, right? You saw the reconciliation. But there is always a way out, like you saw with the Twitter image, right? So the next stage is, what else can we take into consideration? Well, are there country-level characteristics that kind of affect how these measures are disclosed and used? So I will go with you over some of those things. Of course, the firm-level characteristics and how they make their decisions about disclosures are also important. And finally, there are some industry-level issues, not a lot, but some. Okay? So my first paper really was on what did Regulation G do, okay? And this is how I get, I don't know, half of my citations, because I showed that the disclosure of those measures went down, okay? So that's how you see me more frequently cited. The disclosures went down. It's not very amazing, but that's how it is. Another thing that came out of my paper is that there was a statistical difference and a statistical different reaction to the adjustments that the managers did when they calculated these numbers and the adjustments that the analysts did. So it turns out that the managers could adjust to 10 different things, but then when the analysts had to calculate their own numbers, they would look at the 10 different things and say, yes, yes, no, yes, yes, and then eliminate some of the adjustments that the managers did, right? So this led to another stream of literature, which is now called street earnings, that just analyzes how many of the adjustments made by managers the analysts do believe and incorporate in their forecasts, okay? The next paper, and you see Jennings, that's Ross, my advisor is a co-author, that we did was, okay, we know the regulation had an impact, but did it have an equal impact in all of these firms, right? It's just a blank slate over everything. And we thought, oh no, the corporate governance of these firms should have an impact. And sure enough, we did find that yes, the corporate governance did have an impact. The impact of regulation to, let's say, curb the bad disclosures was felt basically on the bad corporate governance firms, okay? So corporate governance did replace regulation before it came out, but once the regulation came out, everyone was on the same playing field, let's say. Now, we have been discussing the US, let us flip to Europe. Okay, so what happened was that I flipped to Europe, right? I went to Portugal, and sure enough, I get to Portugal, and I met this researcher, Helena Isidro, who was part of the European Financial Reporting Advisory Group, EFRAG. And she said, you know, at EFRAG we are discussing these measures. And I said, good, what do you know? And she said, well, we don't know anything in Europe. What do you know? And I said, about Europe? Absolutely nothing. So we were stuck. Okay? None of us knew anything, EFRAG didn't know anything, so basically no one knew what was going on with this thing. And of course, we researchers thought, we are going to do this, okay? No one knows what's going on, that's where we're going to step in. Because what EFRAG saw was that when they looked at it, their conclusion in 2009 was the items adjusted for vary not only between different companies, including within the same market segment, but sometimes over time. So basically there was no consistency anywhere, and they didn't really know what to do with it, okay? So that was the scenario in 2009 when I started my project with Elena on non-GAAP disclosures. And then many years later, 6 years later, finally ESMA, the European Security Markets Agency, did came up with something. It's not a regulation like the US. These are guidelines. And then each country has to apply them and has to make sure that they are being followed, okay? No one really knows how the country-level organizations are following up on this, so it's still an open question how well this is working. So here's an example of Nestlé. Of course, the European firms also disclose this information, right? In this case, Nestlé calls it underlying trading operating profit, underlying earnings per share, free cash flow. This is what they disclose, the last press release, okay? Now, what did we see about Europe? What we saw was, well, here's all the data we have. It's about 20 countries in Europe, and now what do we conclude? And what we concluded was there's a lot of institutional economic development factors of these countries that do affect the way these measures are disclosed, right? So in fact, what we found was if the capital markets are more developed, there's a lot of analysts looking, and there's a lot of scrutiny from the authorities, so earnings management is harder, then the firms will try to manipulate the investor's perspective through non-GAAP disclosures, right? They say, oh, look, there was this benchmark here. We didn't beat it with GAAP, but we are going to give you this very nice number that is higher than the analyst consensus, okay? So that was the first thing we disclosed. We earned 2 Best Papers Award, and let me talk to you about the specific case of the UK. Okay? So in the UK, there was a standard that allowed it, these extraordinary numbers, let's say. So these alternative performance measures were allowed under the Financial Reporting Standard 3, not anymore, that standard is gone, and so there were studies that looked into this. All of the studies either have Martin Walker, Steve Young, or both, okay? So if you want to know what happened in the UK for these measures, you just need to call those 2 guys. I have, they're both coming to NBS next year, okay? So if you want to see them and know more about that in the UK, that's it, it's easy, just come to our seminars. So let me give you an example on Tesco, okay? So here's last press release from Tesco. Notice how different it is. You first have all the non-GAAP measures, right? Group operating profit before exceptional items, diluted EPS before exceptional items, etc., etc. And then below this would come the statutory measures, right? And now remember the nice reconciliation that CVS gave you? This is the explanation that Tesco gave you. Okay? So it is a different setting, right? Firms do respond differently to what's going out there, right? So you don't get that much detail about what they did. You get that text and not after the disclosure at the bottom of the press release, right? I had to go dig it up at the end. Okay, we are done with that. We are moving on to firms' decisions. So you saw CVS reconciliation going from one measure to the other. Now let's say that the firms decided to give you this. This is what we call a side-by-side reconciliation. So instead of going from that first GAAP number to the non-GAAP number, we here at AstraZeneca believe that we're going to give you the more detailed information all the way through all the lines of the income statement. So all the lines of the income statement have a GAAP and a non-GAAP version, okay? And let me just ask you for a show of hands. Is this more helpful than the one from CVS? Who believes that? 3 people. You are correct. So statistically, capital markets get a lot more information out of this format. What happened in the US though? The SEC came out and said, forget it, we don't want this. Why do we not want this? Because it gives too much emphasis to the non-GAAP measures, okay? What happened next? Well, frankly, and this was last year, wrote a paper showing that the firms who stopped disclosing this kind of reconciliation had a hit in capital markets, and now their disclosures were not as informative as they were before. So he was called to the SEC to explain why he was presenting a paper that showed that the SEC made a mistake, literally. Okay? So, of course, we already knew that those things were informative. I had written a paper about that in 2010, and then frankly got called, thank God, because he wrote a 2018 paper. Okay? So what adjustments are firms doing, basically? Well, as you can see, this is from another paper. This is from Black et al. It's still a working paper. But they do collect information on the kind of adjustments being done. And so firms are taking stuff for restructuring, taxes, acquisitions, impairments, legal costs, divestments, debt, tax, etc., etc. The question is, do you believe these are non-recurrent, or do you believe these are going to happen again? Right? Because if these are non-recurrent, then yes, we should believe the adjustment and take it. Otherwise, we shouldn't. Right? So it's a case-by-case analysis. Another thing that you have to take into consideration is, how are these measures disclosed? So let's say that you get the same press release, but instead of bullet points, that number comes in a nice paragraph, and it says, surprisingly, we beat the average of the industry, and our earnings are much higher than expected. They are, I don't know, put whatever number you want, 75 cents, way higher than the previous year results, okay? Look how much nicer this looks like this, right? So we came together with an expert on impression management techniques, right? Well, what can firms do to make it look nicer, right? Because we know that has an impact on market reaction. And sure enough, we saw that every time that the firm came up with this very nice text about how surprisingly their earnings were, the adjustments were worse. So they were adjusting for things that were persistent, right? So they were kind of trying to cover up what was going on and what they did with the calculations. The interesting part, though, is if they have a very high impression management use, so if they kind of overdid it, then the capital market would penalize them, right? So somehow it served as a red flag, and they will go and dig up, why are these firms being so lively in their description of earnings, right? And it would backfire. The strategy would literally backfire. Okay, there's also links for compensation. And now at an industry level, what we have to say is that some industries have specific measures that they use frequently. Other industries just focus on one or two specific measures, right? And then competition is also an issue. So it turns out competition also serves as a kind of regulating mechanism, right? So if your firm operates in an industry with high competition, and you're a bad performer in the industry, you will not come out and make a ton of adjustments, right? Because they know that the other firms that are keeping an eye on what you're doing and what you're saying are going to call you off on that bluff, okay? So competition also helps to regulate what kind of non-GAAP disclosures are made. Now, let us talk about the future for the next few minutes. What is going on? So like I told you, in Europe, there's no hard regulation. So instead of the SEC, what happened was that non-GAAP disclosures were kind of taken on by the ISB, okay? And so the International Accounting Standards Board came out and said, look, we have issues with disclosures. We have to do something, okay? And so they put up an entire list of issues that they had with disclosures, and they put out an exposure draft, okay? A discussion paper on the disclosure initiatives and principles on disclosure, okay? They put this thing out. Everyone started to write comments and send them in, as they asked for. And the last time Mary Tolkar from the ISB talked about it, she said, well, we had all sorts of comments. Some people loved them, and they thought, oh, they're the best thing in the world. And some people said, kill them all. We don't want to see them. Okay, we never want to see those figures again. Okay, so there was a high discrepancy of what people thought was or not a good idea to disclose. But the fact is that at some point, two sections of this disclosure were associated with non-GAAP. And the feedback was such that they did decide that they were going to pass on, let's say, this disclosure of non-GAAP measures to the primary financial statements project. So in March of 2019, they said, we have to do something about these measures, and we're going to do it by changing the financial statements. Okay? So that's where we are right now. So Mary was at the AAA American meeting, annual meeting last August, right? And where are we then? So basically where we are is that the plan and the new exposure draft will come out before the end of 2019, they say, is to create subtotals into the financial statement. Subtotals that will somehow replace the need for some of these non-GAAP disclosures, like, for example, an official definition of operating profit or an official definition of EBIT, okay? Now, the thing is, if we create an official fixed definition, then the flexible part of these numbers is gone, okay? So the part that allowed some of these numbers to be more informative because they were tailor-made for that firm, for that period, kind of fades away, okay? But the thing is that the hope of the ISB is to increase not only transparency, saying this is how these things are calculated, and that's it, right? There's no question about what that measure is, but also to increase comparability. Because it is true that if you look at the non-GAAP figure in one quarter and then again the next quarter, it may have been calculated in a completely different way, right? So you don't even know why they took some things this quarter and another bunch of things the next quarter. So yes, it will increase comparability. Yes, people will know what that measure is, but I personally do not believe it will fix the problem. Why? Because the firms will continue to create other measures, and they are still free to create other measures beyond the ones that they put in the financial statements, right? The only requirement that the ISB is planning to impose is if they do disclose these other measures, then in the notes to the financial statements, they will have to explain how these measures were calculated and whether or not there were changes in the way that these measures were calculated. So yes, there will be some definitions, hopefully, but there is still, hopefully, going to be flexibility. Now, the analysts and the regulators do not enjoy this flexibility at all, okay? Last year, I was in a panel, in a discussion of the ILFIN conference, and it was the regulator, the guy from ESMA, the central management banker, and me in the middle, okay? And both of them were saying, this is going to be great, we are going to kill them all, okay? And then I started to say, no, it's not great at all, so the informativeness is going to disappear, and the thing, at some point, the discussion was so heated that the organizer said, okay, let's leave it for the break. And if you can imagine that the guy from ESMA is also Portuguese, you can imagine how heated up between the two of us, the discussion was coming up. Right, so it was a nice experience. So the new exposure draft will come up in, hopefully, before the end of this year. This thing is going crazy again. And in January 2020, Antarca from ISP will come to NBS to explain to us whatever the new exposure draft talks about, okay? So hopefully we will keep current about everything that is going on. So, what is my conclusion? Okay, I told you in the beginning the conclusion was, should I turn it off? There we go. I told you in the beginning that the answer to my question was, it depends, right? So there we are. Now you see why it depends. It depends on a lot of factors, right? It depends on which country you are, how publicly visible the firm is, how much the firm is worried about the analyst consensus, how well organized is the corporate governance, how much are they willing to let's say, pay in terms of performance for executive compensation associated with these measures, because they are also used for executive compensation. So it depends on a lot of things, right? And should you kind of trust and believe these measures? Well, yes, if they provide you with enough information that you can backtrack, look at the adjustments, and make your own mind if you think that that adjustment is in fact something non-recurrent. Because if you think that adjustment is going to come up every quarter, there are firms that, for example, adjust for depreciation. Come on, they're going to have depreciation every quarter. How can they say that is non-recurrent, right? So if you think that adjustment is not valid, let's say, well, then don't believe it, okay? Now, in the new format, the one where they change the income statement, if that does go through, right, then the expectation is there is going to be some measures completely defined. They can still tailor-made some, so then we'll be left to wonder how those were calculated and how those were disclosed, okay? Thank you for your time. Thank you for coming. I'm open for questions.